They're coming. Perfect. Welcome, everybody. Welcome, folks. So happy you joined us today. We'll be getting started here in just a few minutes. Hi, folks. Thanks again for coming. We'll be starting here in about 4 minutes. Couple late stragglers. Welcome to the call, folks. We'll be getting started here at 2:05. Okay. Good afternoon, everybody. We'll be getting started here in about 1 minute.
Love, can I get that a little quieter, please?
Anthony, we heard that one.
Okay, thanks.
Okay, folks, we're about to get started here. Welcome, everybody. Thank you so much for joining us. It's part of our Mastering Financial Statements webinar series, essential webinar series for small business owners. This is our second of many. So thanks for joining us. And those of you that were here with us in our last webinar, we're going to expand on some things and do a little bit of a deeper dive. So we're really excited about that. As a reminder, please feel free to drop in any questions as they come to you. You can type them into hitting that Q&A button on the bottom of your screen, and we will get to some Q&A at the end of the presentation. So please feel free to add there as we're working through. Next slide, please. Let me make some introductions here real quick. Same as last time, we have with us Ceteris' Chief Revenue Officer, William Worthy. And Will is based in Charleston, South Carolina. He's been with Ceteris for 8 years. And you'll see a slide at the end of the presentation with his direct contact information. So whoever wants to speak with him or has any follow-up questions can reach out directly. Next slide. I'd also like to introduce our guest speaker today, Tony Foscolos. Tony's been doing this for 25 years, serving as CFO, CEO, and CEO, and achieving tremendous 30% year-over-year growth for over a decade. Tony works remote, helping small businesses scaling to mid-market levels through consulting and fractional CFO services. Tony, welcome, and thanks for being here today. Last slide here before we get into the presentation. Hit enter one more time. Our mission, Ceteris's mission is to help small business owners meet their business objectives by providing timely, accurate monthly financial statements. And let's go through quickly here what we're going to talk through today, and some of the learning points and what we want you to leave with. One, we're going to recap the basic financial statements from session 1. We're going to review principles of modern accounting, double entry, and core principles. We're going to talk through the cash method and the accrual method, as well as a modified accrual method, and we're going to explain those. And lastly, we're going to give you examples of the different accounting methods and discuss how they impact financial results and profit.
Right.
So without further ado, Tony, all yours. Thank you very much.
Thank you, Saulo, and thank you all to everyone who's joined us for today. Again, our objective effectively is to make you smarter at your financial statements. Your financial statements are a very valuable tool, and they help you run your business better. And every month, there should be something that you really look forward to looking at to seeing how your business is performing. So what we're trying to do in our sessions is to help you become wiser and smarter at reading these statements so you're running your company better. Perfect. So in recapping session 1, let's begin with the balance sheet. As we've stated before, what is a balance sheet? It's one of the main financial statements. And it really effectively, it shows readers what the businesses own, which is the assets. Now, what we're also going to do is I'll just give you a few little tidbits now, but we're going to expand into all of these financial statements significantly more as our sessions progress. But one of the tidbits I'll leave you with is that whatever's closest to cash is ranked at the top of your assets, and whatever is furthest away from becoming cash is at the bottom of your assets. So obviously the money in your bank is really quick to being cash, and trying to sell equipment takes a long time to make cash. So that's the ranking of your assets. Your liabilities, okay, is what your business owes, okay? So we have our assets, what you own, your business, your liabilities, what you own, and they too are kind of ranked in their priority of what you're going to be paying quicker to what you have to pay longest out. So for example, in this case, the owner's loan or emergency disaster loans are very long loans. So they're getting pushed towards the end of the statement. Now, the difference between your assets and your liabilities, or the difference between what you own and what you owe, is your equity, and that's what you have left over. Now, it is a balance sheet, so it does have an equation. It has a mathematical equation, which is your assets equal your liabilities and your equity, or what you own equals what you owe plus the balance of what's over what you own and owe. Or you can also write this way, which is what I own, okay, is effectively what I own is whatever my assets are less my debts, and that's what's really mine left over. So that's your balance sheet, and the balance sheet is important to understand that it is an equation, because we're going to talk a little bit about debits and credits here soon, and we're going to talk about how the debits and credits flow between the balance sheets and the income statements. All right. So the income statement is another super important financial statement, and its purpose is really to kind of show how much money you made, which is your revenue, okay? And then how much money you spent, which is your expenses. Now, our expenses, we generally segregate them, okay? So what we'll do, for example, in cost of sales or cost of goods sold, is we'll try to put the variable costs, okay, on that side of the equation to come up with your cost of sales or your cost of goods sold. So those are variable costs. In other words, if I'm selling one more unit of whatever I sell, we expect these numbers to change because you sold one more unit of what you sold. Your operating costs or your fixed costs are then listed below your gross profit. And in those costs, the nature is such that they typically don't change when there's smaller variations in sales. They do change, but they change in what we call a step-up cost. So the difference between what you've made and what you've spent, okay, gives you your profit. All right, so profit equals your revenue less your expenses. It's another mathematical equation, and it's a mathematical equation that ties to the balance sheet through the debits and credits. We'll talk about that a little bit more this session, and certainly a lot more in other sessions. All right, let's talk about the last statement. The last statement is a statement of cash flow. And really, its whole purpose is just more or less to let you know what's happened with the cash in your business. So how much cash came into your business is considered an inflow, and how much cash left your business is considered an outflow. And effectively, the difference is your net cash or your ending cash balance. This formula is kind of written as the following, which is your net cash equals your net income, or how much money was left over, okay, which is your cash in and out of operations, okay, and then your cash in and out from investing activities. Now, investing activities are things like buying an asset or buying something that lasts a long period of time. And that obviously can be a huge outflow of cash. So that's getting separately outlined on this statement. Conversely, if you're selling one of your assets, let's say a vehicle the company owns, you're getting a huge influx of cash. And that's kind of from your investing into your own business. And then the financing activities is kind of like if you're raising money for your business, or if you're going into debt and raising cash through debt, or you're repaying cash or your debts through cash, or repaying your investors as well too. So that's the statement of cash flow as well. And those three statements make up our typical three financial statements that we really focus on when analyzing our past performance. So the basic statements, again, recap: you have your balance sheet, what you own less what you owe, and the difference is your equity. You have your income statement showing you how much the business made and how much you spent and what was the difference, which is your profit. And then you have your statement of cash flow. Okay, that explains, again, how much money was generated from a cash point of view and how your cash was spent. All right, perfect. So basic monthly financial statements enable us to do real-time performance evaluation. So you're not getting your financial statements done monthly, or you're not getting them quarterly, and you're only doing them annually. You're not getting that real-time performance evaluation, and you don't know how to course correct. So the other great thing about monthly financial statements is they're accurate and they provide rapid decision making. Now, we're going to talk about accuracy a little bit more when we look at the different types of accounting methods in the subsequent slides here. There's another reason why people do financial statements, and that's effectively because they have to, okay? They have to maintain partner relationships, or they have to maintain compliance. So that could be government compliance, it could be bank compliance, it could be compliance with the master franchisor, okay? Those kinds of issues that you have to provide your financial statements for, and including, of course, your taxes as well. So what are your next steps? So the next steps is obviously keeping accurate records, do your monthly accounting and bookkeeping, and then most importantly, set aside some time to review the financial statements, okay? We're going to learn how to review those financial statements in many of the next sessions. But even in this session, we're going to start to introduce different ways that all analyze your financial performance. So I'll bring out those points as we hit them in the slides that we're going to do. But again, this is a tool to help you run your business better. That's the main objective of the financial statements. All right. Okay. Well, we'll do this once, we'll get it out of the way and won't have to do it again, but it's important to understand, okay, some of the basic principles in accounting, okay, one of which is called the double entry system. So we'll talk about that. We'll also talk about the alternative to the double entry. Then we're going to talk about some of the core principles and some of the accounting principles as well, too. There's many accounting principles. Honestly, you could spend months learning all the accounting principles. We're just going to touch the high level points on a couple of them that will help you understand decisions that you're going to make as a business owner. Perfect. So let's talk about double entry accounting, the famous debits and credits, and how we all love the debits and credits. Okay. Well, what was used before debits and credits was something called single entry accounting, and that was used in ancient times. Now, what is single entry accounting? That's where you just write things down in a ledger, or today we would write them down on a spreadsheet. Now, for anyone who's used a ledger or a spreadsheet, you're going to figure out that when you're tracking lots of things on a spreadsheet, it's easy to make a mistake. It's easy to forget something or to write the wrong number in. And then suddenly now, how do you know that you're catching the mistakes? Well, the answer is you don't if you're cross-referencing unless it's really obvious. Okay. So single entry accounting, okay, doesn't have a check and balance. It's not a double entry system. You write it down once. I made a sale to Jane, okay, for this amount. I sold to Joe for this amount. I sold to Bill for this amount, and so on and so forth. And you're just writing it down. In this case, it would be in a sales ledger. All right. Double entry accounting, on the other hand, is very different. Okay. It's been around about 500 years. It was the good old Venetians that started it, came up with this, and very smart mathematicians that figured this all out. And it is complicated, but it's also simple. It is also brilliantly figured out as well. But one of the key features about these double entry accounting is the following, is that they're dual in nature. So I gave you an example just a few minutes ago of a single entry system using John, Bill, Jane, so on. Okay. And if we're doing that once in a double entry system, we'd be doing it twice. Okay. Where John paid by cash. Okay. Bill paid by cash and Jane paid on accounts receivable. So now, okay, or on account. So now what would happen is if this was a manual double entry system, you'd have one ledger, which is listing all your sales, and you'd have two other ledgers, one for your cash sales and one for your receivables or on account, and you'd be putting it over there. Now, at the end of the day, you would add everything up and everything would still be in balance because every transaction has two parts to it. Okay, so that's the dual nature. The beautiful thing now is computers have automated all of this, and that makes it easy and it makes it easier to get it done versus hiring all these bookkeepers that used to be done, and it's automated, and you need people like Ceteris and people like that, like our company, to help you go ahead and make good sense of this. But all this double entry is always happening. It's just happening behind the scenes. But some of these advantages of it are obviously error detection. So it helps you identify the errors since your debits have to equal your credits and your balance sheet is always in balance. That's why it's called a balance, but it's in balance because every transaction keeps everything in balance. So that's the nice part about that. The other nice part about it is that, you know, there's a full picture, okay, done through your financial statement. So when you see your income statement and your balance sheet, now these are the two that work together for the debits and credits, okay? It's really quite nicely how everything is orchestrated so it always ties in. Your balance sheets are always in balance through your transactions. It's well done. Although this happens behind the scene when you're getting your books properly prepared, like with us at Ceteris, this is the case in all of your options. You're always getting double entry accounting. One of the other good things about double entry accounting is it provides a higher level of accuracy and fraud detection, which is super helpful. So double entry accounting is a standard as far as accounting goes, but we also have choices around this standard. All right, so let's talk about those choices and bear with me. And we're going to do that, but we're also going to talk about all of these lovely principles of accounting. Okay, well, why do we have principles in accounting? And effectively, we do that because we can't have one person doing their accounting one way, another person doing their accounting another way, another person doing their accounting another way. And then a bank or an investor or a person who wants to buy a business takes a look at it and go, well, listen, how are you reporting revenue and how is this guy reporting revenue and so on and so on. It's trying to compare apples and oranges and so forth, and you just don't know what you're getting. So for that reason, we came up with principles so that things would be consistent and we'd understand, okay, what's going on in this business this business and this business, or what's going on between businesses that are similar, okay, where the accounting has to be somewhat similar as well, too. So that's the whole concept of it. What it's really doing in that as well, too, is the following: is it's ensuring that your financial report is consistent, okay, it's transparent, it's comparable, and it's comparable across different organizations. So I'm going to highlight a few of the principles that are a little more relevant to the what we're going to be discussing today and moving forward. There really is a lot of work behind all the principles and what are the exceptions of all the rules and so forth. But I'll give it to you at a high level for the core accounting principles. So consistency is a core principle. And what it's generally saying is once you've adopted one method, you can't change midstream, okay? Because you're not being consistent and you're going to confuse or mislead the person who's reading your financial statements. All right, another one is conservatism. So this effectively means be cautious in recognizing revenue and be more aggressive in recognizing your expenses, okay? You don't want to overestimate your results through conservatism. So it may not be accurate, but at least you're not overstating. So I'll give you an example of conservatism at work. Let's just say you're looking at a set of financial statements from a company that's 20 years old, and you're looking at a set of financial statements for 1 year old. Well, both of them own a building, but the 20-year-old, okay, business is reporting the value of that building at its cost, at its historic cost. Now, is that really fair what the value is? Not necessarily, but the value changes often. Okay, so what do? Well, look, as a trained accountant or as a trained business person who's learning accounting, now you know to go to yourself and say, well, this is a 20-year-old business. Is this building 20 years old? And if it is, maybe the value of this building is completely different today than what's on the financial statements, but the financial statements are at least not overestimated. Because if you put the value every year, then what happens when the value goes down? It gets a little tricky. So that's one of the concepts behind conservatism. Materiality. So what it's generally saying is, look, all important information should be disclosed in the financial statements. Any information, okay, that could influence a decision needs to be put. Materiality also has other places where it comes into account, which is, do we do complex things for small dollar amounts? So for example, if you buy a calculator is going to last you 10, 20 years, but it might only be 50 bucks or 100 bucks. Are you going to amortize that as an asset and depreciate it over 5 years? No, you're not. Okay, it's too small. So it's hitting materiality on the other side. All right, the next one we'll talk about is independent entity. Well, what does that mean? That means that as owners, okay, that your personal expenses aren't your business expenses, and that the expenses in this business really belong to that business and not another business, and so on and so forth. So what we want to do is we want to say, listen, when you're preparing accounting financial statements properly, I'm not saying, preparing for the tax department or things like that, but we assume that it's the entity and the entity claim, that the expenses belong to the entity, the revenue belongs to that entity, it doesn't belong to someone else's. This can happen sometimes with resellers, okay? If they're brokering a deal, sometimes they're going to want to put the whole transaction in when really it's just the brokerage fees that should be in. So that's how independent entity can also kind of factor into things. And most importantly, a core accounting principle is accrual accounting. All right, so accrual accounting, and the principle is really kind of simple. It's simple and then it gets complicated, but revenues and expenses are really recognized when they're earned and when they're incurred, not when cash is received or paid. All right, so the accrual also kind of follows something called the matching principle, and we want to match the revenue with the expenses for the period. So what's a great example of an accrual with a matching principle? Okay, it'd be something like, let's say you buy a $6,000 computer system for your store, okay? So accrual accounting would say that we're going to call that an asset. That's not an expense, okay? And that we're going to depreciate that over, let's say, 5 years, $6,000. That's 5 times 12 is 60 months. So $100 a month. So we're going to recognize $100 a month of expenses. We're not going to recognize $6,000 in 1 month and 100 and nothing for the next 59 months. So those are the different accounting principles. And what those accounting principles really do is they help us again be able to compare and understand. Now, it's not just about doing all of this for compliance reasons, for partner reasons, or anything. Remember that the main reason of these financial statements is to help you run your business better. Okay, so if you want to run your business better, you want to make sure that things are accurate and consistent, okay, and fairly represented at each period, or else when you're trying to compare what's going on, you're not going to get a clean comparison of it, and therefore you won't necessarily steward the organization right. So we have double entry accounting, we've got principles of accountings, and now we got choices amongst accounting methods. So let's talk about those choices on the accounting methods. And what we're hitting is there's really 2 choices of accounting methods, and then there's hybrids, okay? So the cash method is one method. The accrual method is another method, okay? And then what lives in between that can be called a modified accrual method. If it tends to be more accrual than cash, we call it modified accrual. And if it tends to be more cash than accrual, we sometimes call it modified cash basis. All right, so let's talk about those, and then let's also take a look at some examples so we can understand the differences of them. So the cash method, okay, it's relatively straightforward. It's kind of easy because effectively what ends up happening is this, is that when you receive the money, that's when it's considered revenue, and until you receive it, it's not considered revenue. So a perfect example of this would be you invoice a client, maybe it was for a big catering job, maybe it was for services that haven't been performed or services to be performed in the future, and you get your money right away. Okay, well, if you got your money right away, then the revenue is considered right away. If you got your money part now, part later, well, then the revenue is considered part now, part later. And if you got your revenue at the end of it, well, then you didn't earn anything until the very end. So that's the cash basis. And for your expenses, it works exact opposite. It's whenever you pay the expense, that's when you've actually considered that it's an expense. Well, all right. So one of those beautiful advantages of the cash method is, well, it's the simplest double entry method out there. Okay. It's also one of the cheapest because it is one of the simplest. It's also pretty much in its standard form allowable for the IRS. Okay. So effectively, what happens with many people is every business can start off small and grow sometimes. And as it starts off small, they just doing their taxes at the end of the year because they're managing their business from their bank account. And just the end of the year, the CPA prepares the taxes and does it for the cash basis. And people are just filing it that way, and they're doing that. All right. So the other good advantage of the cash basis is it does tell you what's going on with your cash pretty well. Although it may not talk about your business performance, it does explain your cash performance. All right. So what is the challenges with it? Well, it doesn't really paint a full or complete picture over the period. So for example, let's just say you had a really good month in your store and you started buying some of that computer system for $6,000. Well, let's just say you made an extra $6,000 in revenue and you just spent another $6,000 for your computer system. So now what you've actually done is you said, well, listen, my profit is unchanged, even though I made $6,000. I guess my point to it is this, is when you have good months and you have lots of cash, then you tend to pay more expenses. Now, should those expenses belong to those periods or not is another question, but that's what you do. Conversely, if you have a bad month, well, you tend to not pay things and even things that you may owe. Okay. And under the cash basis, well, that wouldn't show up as well. Okay. Under a pure cash basis. Well, now that I've told you what the challenges are when you're trying to compare periods, you're trying to figure out what the heck was really happening with the periods you're comparing. And it's kind of tough because you're really kind of paying things, based on your cash balance, not based on how well you're doing. So that can be very misleading, especially if your business invoices a lot. So in this case, if you're transacting your good or service very quickly, very rapidly, it's not as big as an issue as if you're doing stuff in delayed times or invoicing or receiving big prepayments for future things. All right. So there's a place for it. It also misleads your costs as well. Okay. That's definitely the case for inventoried items, because what it's a function of is how often you bought things, not how much is sitting in inventory and what inventory did you start with and what inventory did you end with, but how much did you buy? Okay. Which isn't necessarily accurate. Okay. And it misrepresents expenses because, again, it's a function of what was paid, not what's really owed for the period. At the end of the day, it's not proper accounting, and it can lead to confusing or lower business valuations. It does work for the government. It can work, but I'd like to think of this as a stepping stone to going to more sophisticated systems to help you run your business better. All right. I'm going to go to the other extreme, which is we've got our cash basis, then we have our accrual basis. And remember, accrual is one of the principles of accounting. Okay, in order for it to be what's called generally accepted accounting principles or GAAP compliant. Some of you may have heard of that. So the accrual method is GAAP compliant. The cash basis is not GAAP. However, it is compliant for the IRS and it might be compliant for the owner. So it could work. Okay, but it just is not the best kind of compass to navigate your business ship to. All right, so the accrual method is the other extreme, as we said. And it's an accurate approach, okay? It's the most accurate approach there is, okay? And it adheres to all the accounting principles. Okay, good news. So the key points is revenue is reported when it's earned, not when it's paid. So let's just say we had this huge catering project that was going to start on November 1, and we received the money on October 28th. Well, that's going to be recorded as a deposit, not as revenue in your financial statements because you haven't earned it yet. All right, so that's revenue reported when it's earned, not when it's paid. Expenses are reported to the period it relates to, not when it's paid. So that's another thing with the inventory and the cost of goods sold. When you've sold something, the cost now flows from the inventory, which is an asset, to your expenses or your cost of goods sold. And then now you're matching the revenue from that transaction with the expense from that transaction. You're not matching the revenue from that transaction to whenever you replenished your inventory and how much money did you spend replenishing your inventory. Now, again, if your inventory values are quite consistent, okay, or they're a smaller portion of what you sell, okay, that may not be as big as an item. But when comparing periods and comparing results, it tends to show that it is kind of important to know that even where the inventory, is expensed, okay, when it's used, not purchased. It's just it's a better system, more complex, but better. The other thing about the accrual method is assets kind of depreciate over time. You don't write them off for when you bought them. You write them off for how long they're supposed to last. Now, that can also differ because IRS might give you an incentive to write off things very quickly for tax purposes because they're trying to stimulate something in the economy. Well, what we do as accountants, though, is we follow other guidelines for depreciating those assets, regardless of what the IRS guidelines are. We're trying to match it with the revenue. Typically a computer system would be somewhere in that 5-year zone, things of that. Sure. Okay, perfect. Good. So the advantages of the accrual method, well, you're going to see a few more here, which is it's much more accurate representation of the financial picture. Well, it's also got a lot stronger comparability value. Okay, well, if it's more comparable, it's going to allow you to have better decisions. Okay, and those decisions help promote confidence to the users. And really important that a lot of people don't think about is that when you've got more accurate financial statements and you've made better decisions and people understand what your profits really are, you get a better resale value on your business. Okay, so at the end of the day, the accrual method, especially if you're looking at selling, I'm a big proponent of that. All right, the challenges of the accrual system is it's more complex and it's more time consuming. Therefore, there's a higher cost. Okay, and like every business decision, you've got to weigh out the costs and the benefits. Okay, but okay, it helps you run your business better. And to me, that's usually worth a lot. Okay, can be significant different than the money in or out results. Okay, that's important too, because not only do you have to manage your business from a profit point of view, but you've also got to manage your business from a cash flow. But that's also why that statement of cash flow was created. So we understand what's going on with cash as well, because the cash basis does. Now, the cash statement of cash is kind of independent of the income statement and balance sheet, which really flows with debits and credits, and that does too, but it does in a different way. But at the end of the day, you know, cash is best explained by the cash basis, but your profits and your results are best explained by the accrual basis. All right, so what's the modified accrual? Well, the modified accrual tries to strike a balance between the two, okay? And effectively, it's a mix of the cash and accrual basis, and that mix can change over time in different ways as well, too. So the key points on that is revenue is mostly reported, okay, when revenue is earned, not when it's received, okay? Expenses tend to be reported. Now, those are expenses at the bottom part, not necessarily cost of goods sold, but they tend to be reported when they're paid because it's a little easier, okay? Inventory is typically expensed when used, not purchased. In other words, inventory is maintained. It again depends on the business. And assets are typically depreciated over time. So it's a hybrid, and each hybrid can vary, okay? All right, what are the advantages? Well, it's more accurate than the cash basis, okay? So it's closer to the mark, okay? There's better comparability as well, and it promotes better decision making. So, you know, it's there. And what is its challenges? Well, it also costs a little bit more because we're getting closer to the mark. It can be significantly different than the money in, money out results, and it's not as accurate as the full accrual. So it can still be misrepresentative because it's not fully GAAP, okay? And it's sometimes it's harder to compare to its peers if your peers are reporting a different modified accrual method or a modified cash method than you are. You know, the good news at Ceteris is they have consistency among, you know, the companies we service. So we do things in the modified methods that are consistent, you know, and trying to strike that balance correctly. All right, perfect. So let's go over a quick examples. I'm just going to introduce you to these examples because we want to leave some good time for questions and answers. And I'm hoping you've got lots of good questions and answers, but let's talk about a cash basis example, an accrual basis example, and a modified accrual. All right, so the cash method example. So in this case, it's, you know, we got Fitness Club LLCs, their profit and loss. And what are we comparing? We're comparing September 24 to September 23. I like to compare year over year results month by month when I'm dealing with seasonal businesses. The reason is if I'm dealing with a seasonal business and I'm comparing last month to the prior month, well, there's seasonality differences. Okay, so looking at last September to this September is a great way to see how we're doing. Well, it gets a little hard on the cash basis method, and we'll talk about why. Well, one of the main reasons is because money is being recognized when it's received, not when it's necessarily earned. So, you know, in this case, the membership fees, okay? So are the membership fees, does that include kind of monthly membership fees, annual membership fees? Are they intertwined? So in September 23, did we sell a whole bunch of annual memberships? And I'm reporting all of that year's annual membership right away. I'm not getting it every month. Maybe I had a promotion. You know, maybe it was $20 a month if you pay monthly and $200 if you pay all at once. And now it's in the September 23 that I sold more annual and more people bought the $200 version and less people did in September of 24. So I don't know. Okay. I don't know. It depends on the nature of my business. We got our cross classes. Okay. Well, hey, that's great. It didn't exist in September 23 and it exists in 24. So, hey, that's great. But tell me about this revenue. Is this like a 3 months class membership? And is it just, you know, is it just the money earned, you know, we're reporting again all 3 months when we get the cash. So it gets hard. occurred or future. Now, I wouldn't have these questions if it was done on the accrual. I would know what the rules are. Okay. So I would know that that would be broken out different. So, events, okay, are those events that are occurring in the future? Is that a deposit? I don't know. Okay. So at the end of the day, comparing
Tony, you're
really know
slow.
what's going on. Okay. Also recognize when paying, pardon me?
You cut out
Thanks.
for 1 second. If you can just
Yeah.
start that one thought early.
Yeah, perfect. So comparing earned revenue over the periods is harder as a result. Okay. Expenses are recognized when payments are made. Okay. Challenges again with this can be, well, something as simple as payroll. Is your payroll bi-weekly? Did you have 3 pay periods in one period and 2 pay periods in another? Because that's going to change your bottom line significantly. Rent. Okay, well, there's your monthly rent. Sometimes you're paying deposits or you're paying an extra cam charge or you're doing some kind of true up. Okay, so I don't know, but when I look at the rent line, on the financials, there's a big difference in the rent there. But I don't know what's going on. Did they move to a different location? Don't know. Computer. All right, well, there was a lot of money spent on a computer in September 23 and not so much on September 24. Well, did they spend more money because they made more money? Don't know. So again, expenses are not necessarily a function of what was incurred, but more they're a function of what was paid. Okay. So profits can be misleading. Okay. Now, at the end of the day, the government lets you file your taxes using this method. So, you're compliant with them, but, how well is this helping you manage your business? And the answer again depends on complexity of your business. But profits, okay, they can be misleading if your revenue is overstated and understated, and your expenses, it can be misleading if your expenses are overstated or understated. So remember now, when it comes time to sell your business, okay, all of these questions that I'm having are questions that prospective purchasers would also have in their mind. So that's one of the big challenges with the cash method. All right, perfect. Accrual method. So again, revenue is recognized when it's earned. Okay, so this is Pharmacy LLC. It's a little different type of company, and we're comparing what I call year to date this year or year to date year before. And it's a full accrual. So you see what's happening between the 2 years is I'm getting a lot more optics of what's going on here. Okay. And I'm seeing, a nice growth of $16,000. Okay, that's good. Over the counter sales, has also gone up. And then we're doing some stuff with accounts receivable. But there's extra work that has to be done, but it's giving me a lot more optics on the business. Okay. Work has to be done around invoicing, around maintenance of accounts receivable, but the revenue now is fair on what was earned. Expenses on the other end, they're matching to revenue. Okay. So in this case, the expenses, if there was the computer purchased and things of that nature, that would be depreciated over time. And it would be in this depreciation line number in the profit and loss. Okay. So additional work is often required on that to maintain the cost of goods sold, maintain accounts payable, the assets and the monthly depreciation. But expenses are now represent kind of what was incurred. Profits are now representative of the activity in the period, and they provide more meaningful comparison. They provide more accurate valuations as well, too. And they just make optimizing the business more accurate. Okay, perfect. Look, modified accrual, it's going to mix and match, okay, different kinds of things to different things. So for example, we won't have the depreciation, maybe, the optics around sales might be the same because perhaps we're doing all of the accrual principles around revenue. Okay. But let's just assume that our inventory is maintained. So our cost of goods sold and our gross profit is also kind of somewhat accurate. But some of the items in here, like the assets, okay, might be expense when purchased. So there's no depreciation. Okay, maybe there was a big insurance payment as well for 3 months of insurance. items like this. And now what's happening is that our profits are kind of going all over the place. Okay. So it's closer to the mark, but it's not painting a super accurate picture, but it's closer. Okay. And how close it is depends on how much you move towards that accrual or going there. However, it's not a full accrual, but it's more comparable as a management tool as well too. And it's still not easily to compare to peer businesses. So if you have a choice between buying this one business over here and another business over here, and this guy's using a modified accrual, this guy's using cash, again, you don't really know what's going on, and that uncertainty usually affects the purchase prices. All right. The summary of all of this. Okay, so as an owner, one of the most important decisions you're going to make is what kind of accounting system are we going to work with? And is that accounting system going to change over time as our business grows and our needs change? So effectively, we have our cash basis, our modified accrual basis, and our accrual basis. So double entry. Okay, well, the good news on the double entry criteria, they're all there. Okay, error detection. Well, the double entry under the cash basis is still going to tell you about errors. It's just the timing of the expenses that can be different and things like that, but it still has error detection. It's obviously better in the modified and best in accrual. Well, accuracy, okay, again, the cash basis, it's not that it's not accurate, it's that the timing of things are different. Okay, so it does provide adequate accuracy. The modified accrual does adequate accuracy too, perhaps a little bit better, but the accrual is just best. Okay. Comparability. Well, I'm going to tell you the cash basis is weak comparability because it is. Okay. Modified accrual gets closer to the market, and then accrual gets further, just like that as well. What's the managing value? Well, I think there's still some managing value in the cash basis, but you have to go through longer periods of times to figure it out. The longer the period of time, the more meaningful it gets. If you want to know on a month by month basis, it's a little harder, but quarters or annually, it's a little bit better. If the business is smaller, especially, okay, it's there. Third party value, well, the cash basis is weak for third party value. So that's banks, okay, that could be potential purchasers, potential investors, other third parties. It's hard for them to understand what's going on in the business. All right. Modified accrual is better, accrual is best, and the complexity and cost, well, cash basis is simple, modified is more complex, and accrual is more complex. Great.
All
Well,
right.
that's it.
Thank you, Tony. I'd like to encourage everybody to please, first off, please submit any questions that you may have. We do have a few that we're going to get to right now before we end the Zoom. And Tony, if you could hit next slide, please.
Yes, absolutely.
If anybody has any other questions or wants to talk further around Ceteris and their accounting programs for franchisees and small businesses, here's William's contact information. Please take that down, 864-316-5275, and then you'll see William's email here, williamw@ceteris.com. Okay, first question, Tony. I own two fast food restaurants that do about $1 million a year each. I'm currently getting my taxes and books done once a year. I would like monthly financial statements, and I'm not sure if I should go with a modified accrual or a full accrual type accounting system. What system do you think is best for me?
Yeah. And look, the reality is probably over this webinar, I'm not going to make the right call for you. That would be a perfect time to kind of reach out to William and our team and to have them kind of go a little more in depth with you over that. At the end of the day, if you were planning on selling these relatively soon, I tend to lean more towards the accrual. Okay. If your expenses tend to be a little bit more consistent every month, maybe the modified, but I strongly suggest reaching out to William and the team for a little more depth analysis.
William, I got a question for you here, William, from Christina Dowd, Christina D. Do you have any extra resources on the accrual method available, or do you recommend that she reaches out?
Yes, if you can reach out to me directly, that'd be great. Now we do have some resources I can share, and also happy to have a conversation about it as well.
Perfect. Another question here. Is there a preference? What accounting method do you prefer and why?
Yeah. Well, look, I mean, it depends on the business, how big the business is, how new the business is, but typically for more established businesses, I do like accrual accounting. That's why it exists. It exists to fill a need. Okay. And the need was to better run the businesses. Those Venetian merchants were tired of having theft. They were tired of not really knowing what was going on. That's why the system was created. And it is a logical, good system.
Great. The next question here is, I'm currently using the cash method. That same method that I use for filing my taxes, but I would better like to understand what is going on with my business every month. When is a good time to change? If we're going to move from cash to accrual, when
Yeah.
is an appropriate time to change?
Yeah, that's a great question. Look, there's always a preference towards changing things at the beginning of the year. Okay. Next best is changing them at the start of a quarter. And the hardest is changing it kind of on the fly. It's not impossible at all, but if it was February, March, would I wait 7 or 8 months? No. If it was November or something, I'd probably kick it off in January.
Gotcha. Perfect. Okay, those are our questions, folks. We're going to stay on the line here for another minute. If anybody has any other questions, feel free to add it to the Q&A and we'll address it. If not, thank you very much for attending today's session, and please be on the lookout for a follow-up email with this recording as well as the next session. Thanks, folks.
Absolutely. And if you're happy with your session, please share that with other people. We're out to share our knowledge with everyone who wants to learn. So please remember to share this with your friends and share this with your other colleagues and business friends as well. Thank you. And comments too. Feel free to write comments down as well.
We got a question here. What would you say is the breakdown between types for Ceteris customers, Mr. Worthing?
Yeah, we typically see a breakdown between our modified cash plan and modified accrual. Most of our fitness, wellness centers we work with are on a modified cash basis, and lots of our restaurants are on a modified accrual plan, and a lot of those include bill pay services as well. And back to the question a minute ago around when do we see changes? It typically is around a start of a year or start of your first period, if we're talking about restaurant books, or it's you're growing from a 1 to 2 unit owner to a multi-unit owner, or you're having some increases in revenue as well and want to account for things a little bit differently. So that's typically what we see from a business standpoint.
Okay.
Great question. Any other questions, folks, before we end the session? All righty. Thank you very much. Wishing everybody a great rest of the week and a great remainder of your Wednesday. Thank you.
Thank you. Goodbye.